What is going on, ladies and gentlemen? I'm not a financial advisor. This is not financial advice. If you want to watch my live streams every single day, I'm currently running a discount if you use code DODGY. Just click the WAP link in the description below. I literally live stream every single day. And I teach you what I'm teaching now, and I also take live trades, but all in live time. So I think it's really beneficial. You can ask me questions, whatever. And yeah, a lot of really nice private members in my Discord as well, with a decent amount of experience. So if you're interested, just click the WAP link in the description. Use code DODGY. Okay, I'm not sure. I'm probably going to keep this code up for about 2 weeks, but that's it. And then lastly, if you want to buy a funded account or an eval account, click the Apex link in the description. Really good company, probably one of the best prop firms there is. Pretty cheap too if you want to practice and buy a couple of eval accounts. So yeah, I'd recommend doing that. So today's video, I'm going to be going over Cameron trading model. Okay, and this is not going to be a very long video. It's basically the 2022 model, except you're going to find a lot more fair value gaps. Okay, so what you want to look for is you want to first identify like where the market's likely headed. Okay, so what you want to first do is you want to identify where the market is likely headed. Okay, so where do you think the drawn liquidity is? Okay, and determine that, I kind of see, are we reacting off a fair value gap or whatever? So if I go to like the 5-minute time frame, okay, and I see right here we're rejecting off a 5-minute bearish fair value gap, and I see us headed for this low. Okay, well, when I see momentum going towards the low, okay, that's where I think the market's going to go to, because it's probably, you can try to see how eager it is to hit stops. So once you identify that, okay, you go down to the 30-second. Okay, and all you're going to want to look for is you're going to want to look for like a short-term high to be taken out, any high to be taken out. Okay, for example, let's see if there's like a high up here. So right here is a good example. So we get this high created at 946. We get this high created at 943. Okay. Now, when we create this high, okay, if we go to let's just go to the 1 minute and see how this looks real quick. Ideally, we want it to be a 5-minute high. So I'm actually going to do this. So we're going to go to the 5-minute. Okay, you want it to be a 5-minute high. And if you look closely, I would say this meets the requirements, because you can see there's a 5-minute high, short-term high made. We take it out and we barely displace over it. Versus up here, not really any good 5-minute swing highs we take out. We never take out this one. We do take out this one, so this does apply here. Okay, this is a swing high if you look closely right here. So we got 2 swing highs. Okay, I think the one down here is the most obvious to find this model, because at this point when we see this candle, we can likely say, okay, the market's headed for this London, or for this low from Asia session, right? So this one, you don't really know the drawn liquidity, but by here you probably do. So I think this would be the better one. But for this example, let's just say we knew the drawn liquidity up here. So we're going to go over both. So now we just go in the 30-second chart. Okay, it's just like the 2022 model. You look for the high to be taken out. Okay, now if we go here, here's the first high, which I'll go over second. And then here's the other high. So what you want to do is you look for the high to be swept. You do not want to see displacement over it. And then all you do is look for a fair value gap to form, and you enter in that inside that fair value gap. Okay, now look right here. Here's a fair value gap. It's a single fair value gap. Do we ever enter inside of it? Nope. But what you can do is you could actually, and if you think we're not going to retrace in the fair value gap, which sometimes happens, what you can do is you can actually enter once this candle here, this 958 candle closes, and then your stop just goes like maybe close above the fair value gap, because it doesn't really matter where you enter. The stop and take profit are still going to be the same. So the stop is going to be 10 points. So let's say you enter in this candle close. 10 points would be plus 10. So, or it would be a 12-point stop loss. My bad. Okay, 12-point stop loss, 10-point take profit. So it would be 27, 28, 29. So the stop loss would be up here. And the stop loss in here is well above this fair value gap, meaning if we do hit your stop loss, we were probably just going to go much higher. And then, again, let's do enter this candle. Okay, your take profit would be 10 points down, which would be 07 down here. So you can see the first play, this works, even though we don't really get that fair value gap retracement. It's up to you whether you want to wait or not. Okay, you could do it both ways. I've seen both examples work fine. This one, the risk reward isn't bad because this candle doesn't really close that far beneath this fair value gap. So this one, the top would be tighter. But let's say the candle closes like way down here, then I probably just wouldn't touch it. But because of this candle close, not really closing that much, this is probably much better to take. Okay, now let's go down again. Here's another one. We take out the 5-minute high, bearish fair value gap. You could either enter in this candle right here, or if you don't think we're going to retrace, you enter in this fair value gap, which this time we actually did. So again, this is just a model, right? We got the fair value gap. We took out a 5-minute high. We know the market at this point is likely headed down to the Asia low. Okay, and then here you can see the stop loss would be, if you're entering right at the fair value gap. So this is your entry, 15,382.25. So your stop loss would be 829,294. So your stop loss would be up here, 12-point stop loss, and then your take profit would be all the way down. If we look, 8272. So your take profit would be about right here. Okay, and you can just see this play works fine. Okay, we take out that 5-minute high, then we get the 30-second fair value gap. And sometimes these are going to appear in the 1 minute, sometimes they're not. I guess he likes using the 30-second in case they aren't, but you can just see 2 for 2 already. And none of these over here apply. Okay, it has to be a 5-minute swing high taken out like this or like this. Okay, none of these apply. Okay, so that's the thing you got to look for. So this is a little short summary how to do his model. Again, 12-point stop loss, 10-point take profit. You're not really basing your stop off the chart, although that's what I do. This is just you basing it off of 10 and 12 points. So 2 really nice examples work there. As you can see, we never take another 5-minute high after, so there's no valid setup. But yeah, hope you guys enjoyed this video. Let me know if you have any questions. And yeah, peace out.